by that 90-day tariff pause announced by the U.S. president. Our next guest says there are opportunities right now. He sees them in cash-generating sectors like utilities and healthcare. Gaurav Mallik is Chief Investment Officer at Pallas Capital Advisors. He joins us from near Brookline, Massachusetts. Gaurav, thank you very much for joining us. First of all, what's your take on the mood of investors right now? It was euphoria yesterday afternoon. It's much, much more cautious today, it appears. Investors seem to be very quick to take some profit off the table.
Yeah, I'm going to be boring and say what you've heard already from others too, that, we're kind of out of the woods, but not over the hill. We think at 19.4, 19.5 on the S&P, you kind of are balanced. Entering the year, a 2021 multiple made sense as long as we were going to see multi-year single-digit or double-digit earnings growth and peak margins. Given that both of those are at risk today, I think that kind of the risk-return trade-off is fairly balanced right now. So I'm not surprised that investors are taking a pause at this stage and just thinking through what the next 90 days are going to unfold, what the earnings are going to look like once we start getting the first earnings coming out. Well, we had some yesterday, but again, the banking sector comes out tomorrow. That'll give us a really good read through as to how much concerned they are about the consumer loan book and growth.
Does that balanced risk-reward profile suggest that you think that we may be at a stock market bottom right now or close to one?
I think we're at I would just say fair level. There is room, of course, for the market to go down too if there is an increase in retaliatory tariffs and there is no resolution with China. Clearly that's a big factor to play in driving markets downwards. However, again, a resolution would get us to a better place, but I think this is a fair level. So I don't think we are suggesting that we're going to see multi-year highs showing up in the S&P this year, given that, again, earnings are going to be slightly stressed, margins are going to be slightly stressed, with the 10%, with whatever's going to occur with China. So not near bottom. It could fall a little bit more, again, if there is a degradation in the communication around tariff policy. But generally, we take the view that we're looking at low single-digit returns for the rest of the year.
This will be an awfully interesting quarter of conference calls as senior executives talk about the macro environment, and they will surely talk about the tariff situation. They'll be asked questions about the tariff situation. What do you expect them to say? What kind of questions would you like them to be asked?
I think we would like to ask them that, how they're thinking about the various tariff scenarios. It would surprise me if most CFOs aren't spending the time thinking about what if. Of course, everybody should have a game plan for what they're going to do with 10%. So I think that's a minimum in my view, because I do take the view that 10% is here to stay. Beyond that, it's like, what if things get worsened with China? How are we thinking about adjusting a supply chain? So I think those what if scenarios would be what I would be asking them. And again, I'm not looking for an answer, but I want to know that they're thinking about all the scenarios and have a game plan in place in case we see an escalation.
Okay, you say in some commentary that you do see opportunity in these volatile markets in high-quality cash-generating sectors like utilities and like healthcare. Why don't we begin with utilities?
Yeah, so utilities, again, it's a very classic story. It's after a long time a sector which has stable cash flows, can pass on inflation. But in light of all the needs that are there, which we do think AI is a big theme for the next few years, it's a sector that stands to benefit from it. So it has a growth characteristic. It has, an inflation protection characteristic to it. And then again, if there is a downturn that occurs, it has some stability in cash flows. So many reasons why we like utilities from that standpoint. But to be also very candid and honest with you, we have sort of utilities on one side, and then the other side, we're looking at the high beta trades around financials too, right? But I think utilities is a good, safe place to be.
Okay, and talk about healthcare as well. You put that in that same bucket of high-quality cash-generating sectors.
Same reason. I would say it's super high generating. Again, we are going to see that as you go through periods of volatility, that's one thing that investors that most people in the world are going to need, which is healthcare. We like the fact that there is a good pipeline occurring across the pharma sector. Some concerns about what the administration is going to do as it relates to tariffs on that specific sector. So I think that is something that we are paying a lot of attention to. But on balance, it seems to be a reasonable place to be. And again, there's a lot they can fund on their own through the high level of cash flows that the industry generates.
Let's finish with the financials. A lot of the big names on Wall Street, the money center banks, the shares of those banks much cheaper than they were just a couple of months ago, at least on a pure price basis. What are your thoughts on that sector right now?
Well, if we don't see the worst scenarios play out, right? So right now, in the middle of the worst period of the stock market fall, we saw financials as a proxy trade on recessionary fears. So everybody who's concerned about recession was dumping these stocks. I think the recessionary scenarios have basically disappeared in my view. I don't think we see recession occurring right now, which means there's a repricing that is occurring with financial stocks just on that basis. Layer in the fact that the big money center banks have diversified businesses. They would have taken advantage of the volatility in the marketplace in the first quarter. They have stable asset and wealth management businesses, franchises. And again, we're going to see that rip through. So if the pace of rate cuts is slower, if the curve starts to steepen, NII concerns can be alleviated. The main thing to look out for, frankly, with this sector is going to be just what they're doing in the way of credit cost. How much are they booking aside for delinquencies in consumer loans, corporate loans, the PE sector writ large? So I think that's the one to pay attention to. But if those numbers are within margins, within slight margins, then I think it's a sector that is going to be a high beta play on stability, high beta play on those recessionary fears disappearing, which is why we like it.
Gaurav, thank you so much for your insight. That's Gaurav Mallik, Chief Investment Officer at Pallas Capital Advisors, speaking to us from near Brookline, Massachusetts.